Thursday, August 12th, 2021, Maneco 64, home of alternative economics and contrarian views. So, is inflation really over? Has it peaked? I see a lot of headlines, a lot of people saying that inflation has peaked just because the CPI wasn't higher than the previous month. I think they're completely wrong. I agree with Rafi Farber from the Endgame Investor completely. It's far from over. And one of the reasons why he has been able to predict the rising prices, which people call inflation erroneously, is that we know the real definition of inflation. So before we go over the numbers and what Rafi thinks about it, and the reason why I'm referencing Rafi is because he was talking about this late last year, early this year, that we're going to see prices pick up from May, and he's been completely right about that. But before we go onto the numbers, let's look at the Merriam-Webster dictionary definition. Yes, it's an old one. Used to be my dad's. This is from the 1970s. So if you open up to inflation, it says an abnormal increase in the volume of money and credit, resulting in a substantial and continuing rise in the general price level. So it's not the CPI. The CPI is only a measure of consumer prices. And we know that the US government and the statisticians have been tinkering with the statistics for decades. We know from John Williams of Shadow Stats that if we look at CPI, how they used to calculate that back in 1980, we would be running around 12-15%. But unfortunately nowadays, even in higher education, university, master's degree, PhD, students are taught that inflation is the CPI, that the CPI is inflation. They aren't taught what the dictionary said about 50 years ago, that it's really the increase in the supply of money and credit. The other thing that they've done is that there's no backing anymore to the currency. So there's no gold backing or silver backing, so they can increase that as much as they want. And that's why the Fed does it with its QE. And that's why the government has been able to borrow so much. Imagine that the US had less than $1 trillion in national debt when Reagan won the election in 1980. And now it's up to 30 trillion basically, and it's going to blow through that very quickly in the next few years. I think it's going to go to like 50 trillion in 4 years. So it's out of control, and that is inflation. But if you listen to CNBC, Fox Business, or Bloomberg, or any other mainstream business networks, if you read mainstream economists, if you read the FT or the Wall Street Journal, they focus on CPI. They don't focus on the fact that other prices have been rising as well, like paper assets like stocks, bonds, real estate, and land, commodities. Actually, commodities are very much undervalued, and that's a different subject. So what we're seeing now is just consumer prices rising a lot. But if you look at things like the money supply, M1 and M2, unfortunately M3, they knew this was going to be a problem, so they stopped publishing that number because they don't want people to look at the money supply. This is what Paul Volcker targeted when he let rates go to 20% in 1980. He targeted the money supply. So back in the 80s, up until the late 80s, the markets watched M3 very closely because that was real inflation. But nowadays we focus on this phony CPI, which only focuses on consumer prices, and that is wrong. And the inflation is going to continue. So if you look at M1, it really started picking up. Well, it's been picking up ever since the early 70s. As you can see, it picked up after the '08 crisis. And I did this because if I had put nowadays there, you wouldn't be able to see the growth in the 60s, 70s, and 80s. But now I'm going to show you the full length chart, and you see how crazy it's going now. That's the money supply now, M1. So M1 is just balances in your checking account, and also notes and coins. That's M1. That's what it is. And traveler's checks as well. I know people don't use those anymore, but technically it is. And then you look at M2, which includes money market funds, savings deposits, and M1. The same story. You can see that it really started growing back in the early 70s. Is it any wonder? Well, that's when Nixon took the dollar off gold and took the anchor of monetary sound money off the dollar. And it's been a lot easier for money and credit to grow. You can see that it's really gone through the roof since last year, and it hasn't stopped. And that's why the inflation is not over. It hasn't peaked. Maybe CPI was the same as the previous month at 5.4 annualized. Maybe it will drop to 4.5. And even if it does, consumers are losing a lot. Their dollar is losing 4.5% purchasing power. And even if we drop further to 3%, it's no good. It's a 3% tax compounded every year. And the other thing that we need to look at is the Federal Reserve, of course. Their balance sheet is going berserk. It's going through the roof. We're at 8.2 trillion. They can't afford to taper, in my opinion, and if they do, they'll have to stop very quickly, because all the financial markets will implode, because they've inflated the financial markets. They're trying to keep people from believing that there's any consumer price rises. They're trying to tell people that this is just transitory, that it's peaked, but it hasn't. The dollar, the fiat currency in your pocket, is going to continue to lose value, and it has been losing value ever since the Federal Reserve was created in 1913. It has accelerated even more this year. So that's the situation, and we're going to continue to see inflation, the increase in the supply of money and credit, because the debt has gotten so out of hand that if the monetary authorities and the fiscal authorities don't stop spending and printing, the whole system implodes. All the talk of taper and raising rates in a year or two is just talk. And this is where we come to Rafi, because he notes in his Endgame Investor report from yesterday, and I highly recommend you look at Seeking Alpha and Rafi Faber. I'm going to put a link to his page below in the description. He writes free articles, but he also has a newsletter. I think is really reasonably priced, around $200 a year. If you're into trading, it's a good newsletter, I would say. But this is what he says about CPI. So let's go through it. So the CPI came in as expected, 5.4%, repeat of last month's year-over-year rate. Compare this with the 1978 to 1980 price inflation. Well, I would say it's just price run, but anyway, let's continue. And we did have a few months of repeat like this. I think we are already at the beginning of a 1978 to 1980 price inflation run. Notice how he calls it price inflation. So here's the chart. And he says, anyway, food inflation is back with a vengeance. And he notes that given what I wrote about Tyson Foods yesterday, whose price hikes will be in the retail market by September 5th, we are going much higher on food inflation imminently. Other companies will follow Tyson if they haven't yet. We will most likely beat the June 2020 food inflation numbers by September. So there you go. It's not over, the price rises, and they're going to continue. And the way governments and central bankers and economists, and why would economists side with the central bank and the government? Well, because the most highly paid economists work for the central bank. They work for Wall Street. Wall Street, of course, owns the central banks. And so they play along with the government and central bank mantra. They say that, well, we peaked. But no, they use people's ignorance, I guess, about mathematics and the fact that if you can compound 2, 3, or 4, or 5% over several years of CPI or price rises, that will be a massive cut in the purchasing power of your currency. That is another silent tax. And most people don't understand it. And the media will play right along as well. They say, oh, it's greedy, Tyson Foods raising prices. I saw yesterday on talk radio, Mike Graham, who's not a, I like Mike Graham, but he's blaming foreign companies for higher energy prices. He's saying, oh, I think it's British gas, which is called something else now, I forgot. He's saying, oh, it's foreign owned, that's why they're raising prices. No, Mike Graham, it's got nothing to do with foreigners raising prices. It's just too much inflation. Look at the Bank of England, Mike Graham. It's the increase of in the supply of money and credit. That's what's going on. So there you go. So let's look at where the markets are now. It's a little later than usual. It's about 8:45 a.m. London. But I saw that gold did very well. One thing that's a little bit concerning about the technical picture is that silver is underperforming. And usually when the precious metals or monetary metals start back up or do well, silver outperforms. So I'm not too excited in the short term. Of course, longer term, there's only one place to be. If you've got any monetary savings, I would leave only the essential fiat currency in the bank. Personally, I try to have as little as possible in fiat currency because it's losing its value. And if you keep huge balances there for years, yes, you'll have $10,000 there or pounds, but in 5 years, that's going to buy maybe 7,000, 8,000 pounds or dollars worth of what you can buy today, while gold and silver have done very well over the long term. I know there are ups and downs, but back in 1971, the price of gold in pounds was about 17 pounds. Now it's over 1,200. It's near 1,300. In dollars, it was, of course, $35 per ounce. Now we're almost at 2,000. So yes, there are ups and downs, but for savings over the long term is nothing better. And some people would argue, oh, but it doesn't pay any interest. Well, right now, U.S. Treasuries don't pay real interest. You got the 10-year yielding just over 1.3, with the currency being debased by over 5%. So there you go. So we got spot gold this morning up another $6. So it's continued to do quite well. It's at 1757. The high's been 1758 and the low 1745. Silver, as I said, is a worry because it's down 7 cents. It should be up quite a bit more normally. It's at 23.47. High's been 23.57, low 23.36. What about the stock market? Well, the Dow futures up 15, the Nasdaq future is down 28, and the S&P is down 1.5 point. The FTSE is up 20 at 72.05. To the currencies, the pound is up slightly at 138.74. The euro is unchanged, 117.40. The dollar is unchanged versus the yen at 110.38. And the dollar is up slightly versus the yuan at 647.77. Aussie dollar is down 0.1% at 73.66. And the dollar is up slightly versus the Canadian dollar at 125.15. WTI crude up 0.2% at 69.20. So I think we're going to go back up over 70. I saw a headline yesterday, President Biden saying that OPEC should increase oil production in order to bring prices down because prices are too high and it would affect the economic recovery. So yes, Mr. Biden wants to have his cake and eat it. Why would OPEC want to increase production and dilute their earnings? I don't see why. While the United States is just printing money and spending money like a drunken sailor. High-grade copper is up almost 1% at 440. The key levels here, I think in the short term are $4.50. After that, $4.66, which was the high in 2011. And then the previous high from this year, which I think was just under $5. I'm not sure exactly where it was. With that, let's quickly look at where the 10-year yield is. It's down just over 1 basis point at around 1.35%. So I think professional investors, especially people who run pension funds, mutual funds, family offices, hedge funds, if they're holding treasuries like that, I think they're doing a disservice to their investors because they're earning 1.35%, and you got CPI running over 5%. Granted, some of them might have bought it when that yield was at 1.7, so they are making capital gains on it in the short term. But for the long term, it's a really bad investment. If you think that CPI is going to stay below 1.5% for the next 10 years, I think you're deluded. I think it's going to be a lot higher. And even if the Fed prints the hell out of the currency and starts buying bonds or treasuries to keep those yields low, the dollar is going to sink like a lead balloon in terms of value in the foreign exchanges because foreigners will see that there's nothing behind the dollar. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.